they have a 4 out of 10 financial sheet. Not my favorite finances I've ever seen from a company. Their revenue is higher. They grew 3.77% on the revenue side of things, but their cost of revenue grew 36%. So that is not a figure you want to see. And they actually have a loss from income operations and a total comprehensive income loss, and which this quarter last year was actually positive. So this is a scary thing for a company. This definitely poses more risk. Not a usual company I'd invest in with a negative PE ratio, to be honest. This was a little bit of a different investment, but I also see a different type of opportunity because they were in a much healthier financial position, a year ago. Past 5 years, they're up 144%, but they're down 67.31% from all-time highs. So that is, about over two-thirds of their company actually got slashed from when they were in the $60 range. But I see this company bouncing back fairly quick. And if you look at this little bump right here, it looks like they have the ability to do so. The stock moves fast on news. So why are their finances so bad? Why do I think this company is so good with such bad finances? You got to know what you're getting into. The main thing is their weight loss drug transition. So this was a major earnings miss by them, this last earnings. That definitely, did not help the stock, but they missed on EPS, losing 40 cents per share when they're actually projected to have a positive EPS. So really bad right there. But they actually are switching over their FDA approved weight loss medications like Wegovy, and their partnership with Novo Nordisk and Eli Lilly is definitely taking away their high margin products, which had some issues with regulatory compliance, so that does not help with the company, and they've since moved on from those products. But in doing so, their margins did actually get cut a lot, as we see in the financial sheet, along with their revenue. They're not, making as much. Margins are a lot less, so profit, you see total operating expenses or cost of revenue is up 36%. So definitely something changed there, and there's something that needs to be changed in the business. But I really like this as a long-term investor. I think that this is a short-wind, kind of just headache that you get when you're in a company like this. You're going to need to make sure that for the long term you have those FDA approved drugs. But margin compression, what we just talked about, astronomical customer acquisition costs. So they definitely do have high customer acquisition costs, but a lot of customers use more than one product by them, which we're going to get into. And then also regulatory and legal crosshairs, which every company in this space faces. So they have an amazing runway for growth, and their total addressable market is undeniable. So Hims & Hers acquired a US-based peptide manufacturing facility located in California to strengthen the long-term durability and quality of its personalized treatment supply chain. This is one of the biggest, catalysts for Hims & Hers, in my opinion, I think is this. I think that them acquiring this peptide manufacturing facility that's all theirs is, really just a big deal for them. I think that's really good for them, and this is going to add to a lot of their financial success in the future. They have their own product, which, they make the price. They're the ones distributing it, and it's peptides, which the global addressable peptide therapeutics market is valued at roughly 130 to 140 billion, and is projected to surpass 300 billion by 2033. I think it'll move much faster than this. Peptides are a very big thing, very big fad, as you see in, weight loss drugs, targeted cancer therapies, and personalized medicine. I think personalized medicine is going to explode over the coming years, and Hims & Hers specializes in that. They're the Amazon of healthcare, the U.S. market leadership driven by a growing ability to do more for customers, and they actually create multiple growth levers underneath Hims and Hers. Like it says right here, we have Hims and we have Hers. So it's both of these businesses for obviously male and female. Hims revenue grew by more than 30% year over year in 2025, while Hers grew by over 100%. So very, very good growth right there. But this is the big kicker, is that 2026, they have their FDA approved weight loss, which just launched in March. So this is going to be a big catalyst for the business, and we're going to see this appear on their Q2 income statement. So the P&L from Wegovy and their weight loss will appear here. You look up Wegovy, you look up weight loss. First thing that pops up, sponsored result, is Hers. So women trying to lose weight, Wegovy, no clinic required. Pen 100% online. You can get this, anyone can get it, and it's really not that hard. And they make it, it's all FDA approved. It's all on the up and up. And they have accelerating international growth, which is one of the most exciting parts of Hims & Hers, I think, is that we see they actually just acquired Eucalyptus in a $1.15 billion deal. So this is going to, allow them to serve Japan, serve Canada. This is going to create, a huge growth lever for growth in their business for the long term. We see capabilities. Their outsourcing facility, 503 billion compounding facility enables, or 503B compounding facility enables launch into new specialties while sterile facilities are required. They have their lab facility, that's great. Peptide facility, that's a huge thing for them, I think. And YourBio, this actually accelerates efforts to redefine and modernize user-centric blood sampling. But international expansion, they acquired Zava. This is great. H&H Canada, they're going to expand very rapidly through Canada, which if you remember in the beginning of the video, they don't have much going on in Canada. So this is going to be great for them. And then also Eucalyptus, which is very popular in Australia and the UK, and also Japan. If they reach into Japan, that's an addressable market. I think international is the future in a lot of stocks, but this one, I mean, they're just going to be able to increase like crazy. And we see the runway for growth is very possible with these new numbers. So in 2030, they want to be doing at least $6.5 billion in revenue. And obviously, every company says this, but this is 4 years from now. And this is 3 times what they did in 2025. So if they 3x revenue and they're growing at this same rate, this company is going to be priced at a very, very high price. And I think we're going to be able to get in on the ground floor right now, which is very confidence boosting for a lot of investors. And another catalyst they have is they're the only telehealth platform that has deals with Eli Lilly and Novo Nordisk. So telehealth company Hims & Hers recently pivoted away from their off-brand compounded GLP-1 drugs, which made them a lot of money. They weren't very expensive to make, but they were not, it was also not FDA compliant. So now they're thinking more for the long term, which I love for this company. It's not going to make their stock price explode overnight as the same way that it did, because margins are going to be compressed for a little bit. But in the long term, I think we're going to see the stock price explode. So obviously it was a big hit on margins, but they're doing directly with major pharmaceutical giants, Eli Lilly and Novo Nordisk. So love to see that. That's perfect for the company. And my overall thoughts on Hims & Hers to close this out is that it's great for portfolio diversity. Healthcare is very volatile. So if you are getting into biotech stocks, keep that in mind. It is very, very volatile. I cannot stress that enough. You're going to have 20% gaining days, you're going to have 20% losing days. So be sure to dollar cost average down, dollar cost average up, but dollar cost average into the stock. They have bad numbers with great growth, which is not my usual investment, but I do see a discrepancy. I think this stock is priced cheaply, which it's hard to value a stock, when they have a negative EPS. It's hard to value a stock. But the growth that I see here with the recent transition in the business, I don't see the same risk to reward that I think a lot of other investors see that are putting a lot of money into this company. And I see the reward as much more than the risk buying a company like this for $20 a share with the market cap of, $5 billion. So I think the risk to reward is very attractive on this. And the long-term runway seems perfect for growth. Company is promising. The company is promising. I will say I really believe in peptides for the long term. I think that's going to be a big thing in the pharmaceutical industry. This is a big breakthrough, and I'd compare it to something like AMD, like NVIDIA, like how GPUs were a big thing. I think peptides are going to be a big way to make money as well. So Hims & Hers is definitely a bigger position that I'm trying to get started in the portfolio for the long term. I really like this stock. So my long-term price target from 3 to 7 years is $80. The backing that I have behind this is all the reasons that I explained in this video. I'm not sure what their PE ratio will be. I'd guess somewhere in the hundreds, honestly, considering the growth that they have possible. But as long as their FDI compliance stays on the up and up and, a lot of things of that nature, they don't run into legal troubles, this is a company that's going to be, it's going to 10x. This is a company that you're going to be able to make a lot of money from if things go right, which looking at the company, the way that they're handling business, the way that things are working, the way the deals are going down, I think it's going to happen. So let's get right into it. If you guys do enjoy this, remember to like and subscribe to the channel. Let's get right into it.
From one of the most followed market watchers, Ed Yardeni says we could get a rate hike in July. Let's get more now from the man himself. He's the president of Yardeni Research, and he's with us live. Welcome. It's good to talk to you.
Thank you.
So you turned some heads today because you're such a bull in this market, and you stay with your target of 82.50 for the end of the year. But you think the Fed could actually hike rates in July?
Well, I think the bond market is calling for that.
I think this is something that we do see 100%. I'm not sure when it'll happen this year. I think July is a little soon, but I think if this continues and rates will hike. And the fact that he's still bullish and guessing for, or, calling for a rate hike is a pretty interesting combination.
Bond yields have gone up is because the perception is that the Fed is behind the curve on inflation. And the Fed has to clearly show that they're dropping their easing bias, which is what they had in their April meeting, and move not to a neutral bias, but move to a tightening bias at the June meeting coming up in a few weeks.
And to be transparent, the president does not want to have a rate hike. That is the last thing that he wants. And if we saw the economy crumble or take a big hit because of that, it would be very sad. But I could see that happening.
And then after that, I think they have to follow up and actually show that they're willing to raise rates and do it by 25 basis points. The 2-year is now indicating that the federal funds rate is too low. The federal funds rate range is 3.5% to 3.75%. The 2 years at 4.1%, and it's a pretty good leading indicator of what the Fed should do, and very often it gets it right.
So you're one of those in the Fed follows the market camp, it sounds like.
Well, I think the Fed doesn't really want,
which they probably should do,
want to get behind the market. Being behind the market is being very much behind the curve, because the market is certainly looking at the CPI and PPI that just came out, and there's a lot of concern that we're back into an inflation mode comparable to what 21, 22. I don't think it's anything like that. I don't think we're going to have another bear market the way we did in 2022. I think the stock market can handle a rate rise in the bond market. Well, right now it's at 4.6%. It's sort of at a critical level. If it goes higher than that, then I think the next stop is going to be somewhere around 4.75%. I don't think we're going to go to 5%, and I don't think these are the kind of rates that are going to really create a problem for the economy to grow and for earnings to grow. So I see earnings continuing to do well. I think that we are going to.
And I don't think rate hikes are a big deal for the economy. I think we are going to see earnings continue to grow in these AI stocks, no matter if the rate is hiked or not, because this is probably going to affect the consumer a lot more than it will the cloud, per se, but that's something to take into account as well.
See some tightening in credit conditions here because of the inflation issue. And I don't think that's going to create a real big problem for the valuation multiple either. It's not a perfect correlation between bond yields and the valuation multiple, and I think the market's still very much focused on the very futuristic developments that are happening now in the whole AI field.
Ed, I'm just going to read you. We're not naive to the moves in the market as we were having this conversation. Guys, let's put up the S&P if we could, please, because that's what we need to see. Can we see that, please? The intraday? There it is. This is on a Truth Social post by the president, who says, I've been asked by the Emir of Qatar, the Crown Prince of Saudi Arabia, and the president of the UAE to hold off on our planned military attack of the Islamic Republic of Iran, which the president says was scheduled for tomorrow, in that serious negotiations are now taking place.
Heard that before. This war seems like it's going to go on forever as of right now, but, it's good that we're getting a little bit of, at least a little bit of news there. There's a lot of time where there's no news, so I'm glad to hear that. But at the same time, it is a Truth Social post, which you can not take 100% seriously. You probably need to take that with a grain of salt.
So we'll continue to follow that. But sure. Ed, this just shows you how sensitive the market is to this issue, right? If you're going to have yields move up and oil move up and attacks move forward, this market's probably not going to take that news all that well, especially at a time where some would suggest the stock market was ripe for some degree of pullback anyway. You just needed the point to which it was going to initiate that, right?
Yeah. Look, I don't really have a problem with the notion that the market takes a pause here. I think it's a good thing. I wouldn't want to see the market continuing to move straight up, led by a narrow group of stocks, led by the Magnificent Seven and led by the semiconductors. I like what I'm seeing today. I like that some money is coming out of some areas of tech that have done very well and going into software. I think that's a good development, a sign that of a kind of a healthy broadening out in the market. And we have seen the S&P 500 index outperform the S&P market weight index. And I think some broadening in this.
We see the S&P outperform because AI is so heavy in there. You look at the tech segment, it's almost 40% of the S&P. So that's why it is outperforming the overall broad market. No surprise there.
Market is appropriate, especially since the underlying earnings picture really is broadening. It's more and more companies, according to analysts, are looking better and better on the earnings front. So I don't think we're going to have a pullback anywhere near as severe as what we had in March. That obviously was when we had the shooting war in the Middle East. It certainly looks to me as though the president does not want to start another round of shooting. And we may just have a status quo where the Iranian ports are blockaded and the Strait of Hormuz is blockaded. Meanwhile, the big surprise is that the price of oil has actually stayed pretty reasonable at $100. I know that sounds odd to say, but
I disagree.
It's not 125, 150, 200. I think some of that is because, fortunately, the Chinese economy is looking pretty weak. The retail sales report that came out just recently was very, very weak.
That's all we have for today's video, guys. So if you did enjoy, be sure to smash that like button. Also subscribe to the channel. Thank you guys so much for watching. And it'll be an interesting day tomorrow for NVIDIA's earnings. I'll catch you in the next video tomorrow. Peace.